Hey, folks, welcome to the Real Estate Leadership and Legacy Podcast. I'm really excited about today's interview with Devin Sembaluk from First National. He is an absolute wealth of knowledge when it comes to commercial real estate, funding commercial real estate. He's got a wicked, extensive knowledge of just the analysis behind why things are moving in the market the way they are. He's been someone that I've been very confident to give my business to. He's helped me out on a number of our larger transactions. So he is someone who is just a natural to be like, you got to come on board, man, and talk about what you do because you are awesome. So I hope you guys enjoy this episode as much as I did. All right, ladies and gentlemen, welcome to the Real Estate Leadership and Legacy Podcast. And I'm super excited to introduce to you guys an individual who I've met through the industry, and now we've become closer through lots of communication. You've helped us out on a number of deals, but Devin Sembaluk. So just as a quick introduction, Devin is a director of commercial financing for First National. And you began your career in commercial real estate shortly after graduating. And so I guess your background is in business administration, majoring in finance. From there, you worked at Concentra Financial, a Saskatchewan-based firm, initially on their treasury team and later on their commercial real estate team. Following this, at Concentra, you moved to Toronto to join First National as a senior analyst. And now you've been a part of First National commercial team for almost 8 years, and you've helped originate just under $1 billion in commercial financing over that time period. That is pretty impressive.
Yeah, it's thanks, Alex. Hey, I appreciate it.
Yeah. So first and foremost, welcome. I'm really excited to have you on here. I think that the chats that we end up having whenever I call you for any sort of advice on how to get financing on one thing or another, they always wind up being these like super insightful conversations on the market and what's transpiring. And so this podcast in itself is largely to help people educate themselves, not just on real estate, but also on leadership qualities, as well as how people can think about creating legacies in their own lives.
Okay.
Yeah.
Cool.
So let's jump kind of right into it. So tell me a little bit about the day-to-day roles of Devin.
Sure. Yeah. So, and I guess you kind of have a good idea of this because we kind of have worked directly on a couple of deals ourselves. But for us, we're kind of front lines. We're on the sales side. So we're going out, finding borrowers that need help with, structuring of loans. Maybe they want to make a purchase. Maybe they want to refinance something. And day to day for us is we look at Excel spreadsheets. It's numbers, it's rent rolls, operating statements, everything. So front to back, we kind of act like a credit arm. We act like a legal team. We act like a sales team, and it's kind of everything. It's a really interesting role that we get to cover so much from start to finish. Seeing a deal come in at the front end and watching it fund, you kind of feel like you're in a relationship with that deal. And every deal is kind of, you're getting closer to not just the people, but the property itself. You're going on site visits, you're kind of handling everything. So day to day for me is honestly just, we go a lot of inquiries, a lot of reaching out to clients, finding out, hey, where's this at? We need information. Let's push it through. Going to different teams internally, externally, trying to solve those problems and closing deals at the end of the day. Even today, just have a funding that's currently going on and just passing information on, making sure we prioritize communication, prioritize all the back and forth that helps everybody do their job appropriately. So
to the earlier point where Devin and his team, you guys have helped us on a number of refinances now, especially through the whole CMHC process, which we're going to touch on as well, because I want to kind of let people in on how that whole process works. But it's funny, usually I come to you with a deal and it's like, hey, Devin, I got this one. I think it's like a good doozy. And you're like, that's actually too small for us. We can't touch that one. It's pretty interesting. Like, so what are some of like the size deals that you guys take, like on average, let's say?
Yeah, so I would say, different teams across our organization deal with different borrowing groups, different structures. So at First National itself, we deal with hundreds of millions of dollar deals to as low as, a $2 million or $1 million deal. So we kind of, and it's all across the country too. So we're kind of dealing with that gambit across a variety of asset classes.
Mm-hmm.
We tend to, on the construction side, want a minimum of 10 million plus if we can. We may make some exceptions to as low as five. Looking at a conventional deal, maybe it's 5 million plus. We can make some exceptions to three, and then if you're CMHC insured, it's a little easier. Maybe some 2 million plus to an exception of 1 million plus. So I think the nice thing is that every deal may be able to work for the right sponsor. So bringing in the right people is really important to us because we can make exceptions if it's someone who has experience, someone who's been in the industry, and we have some long-term relationship with them already.
Yeah, yeah, for sure. The one interesting thing is too, and as I've kind of grown in experience in terms of now transitioning from like smaller single family duplex triplexes, as you
Mm-hmm.
transition into the commercial space, the conversation changes substantially.
Yeah,
It's a different language in
yeah.
itself, and so I know that there was a pretty big learning curve there too because you're often, and I could appreciate why, when you're dealing with large dollar figures, you guys
Mm-hmm.
and the lenders ask for everything in your back, in your shirt, I don't know. It's pretty wild. So, do you want to run us through, like, for a typical deal, like, what would you guys be looking for, let's say I come to you with a potential apartment building opportunity. What are some of the high level documents you guys look for, and we, in comparison to the smaller deals that would be residential, right?
Yeah, sure. So high level, we're looking for some of the same basic stuff that I'm going to guess most lenders would look for. It's current dated rent roll. It's 3 years of operating statements if you have it. Some borrower details. So, your net worth statement. What's your experience look like? Then we want to dive a little bit deeper into the property, get some idea of, okay, how old is it? Have you done any capital expenditures to it over the last 5 years? What does that look like? How's the vacancy been over that time? When did you purchase it? We kind of want to get an idea of how much skin you have in the game and how much work you've kind of done to it. If you're purchasing it, let's get an idea of, okay, what's the purchase price look like? What's the closing timeline? Let's understand, the things that may come up from that side. When can we go do a site inspection, take a look at the property? I think it's those types of things. And in this market, I think that credit side is just growing, where there's more and more requirements that are starting to come up, I think, that maybe 5 years ago, 10 years ago, we didn't really look for. So upfront nowadays, we're asking more questions. I think that's just the nature of credit right now. And, in the booming real estate with, 1% interest rates, that may have been a bit of a different scenario back then.
Do you sense some skepticism from the lenders' perspectives in terms of, like, the economy here in Canada, things like that?
Well, I think it's an interesting question. I mean, skepticism in the sense that I think we've had a pretty strong real estate environment for the last 10, 15 years where
Mhm.
it would be very difficult for you to find a place where real estate hasn't increased substantially over time. Whereas you look at somewhere like the States where they had a major correction,
Yeah.
back in, what was it, '07, '09, somewhere in that range, and their real estate basically makes sense from a valuation perspective. Everybody can afford it. Whereas nowadays, you kind of look at the new generation, my generation younger, it's going to be more and more difficult for people to dive into real estate, whether it's a residential or commercial side, right?
You're referring to
So
here in Canada, though, right?
I am, yeah, here in Canada. So I think personally, I feel like the market's kind of due for a correction.
Hmm.
Um, and I think the skepticism starting to build from that sense too, where there's indicators of potential recession coming. Inflation rates are a little bit higher. They're trying to curb inflation rates by raising the interest rates here. So I think there are some factors that are definitely promoting that. I mean, I don't know if we're as bearish net as we might be. Some areas we are definitely bearish. You look at the office market right now; it's struggling. Vacancy rates are high there. It's the question of work from home always comes up for us, and it's getting tougher and tougher to fill those buildings. So if you have some office exposure, for example, your book might not look as strong as you think it is, because
Mhm.
that asset might have a 30% value or 50% value of what you're showing at market, or what you're showing on your balance sheet, I guess. So I think that's skepticism is probably warranted, I think, in
Yeah.
this market.
So, and to the audience or whoever's listening, to preface the fact that all these things are not any predictions that you hear here are
Mm-hmm.
not set in stone. I think
Yeah.
what we try to do, and this is why I think our conversations are so insightful, is you kind of throw these data points out,
Yeah.
back and forth of what we hear, what's being
Yeah.
released from the stats, and then
Yeah.
you redact from that what you can make of it to help you try to make a decision. And
Mm-hmm.
no, what's the saying is that no market crash is ever the same, but they all rhyme or whatever, or they all leave clues from one another. So it's
Yeah.
interesting to
Yeah.
study, when the last recessions were like right now, the big thing that I've been hearing is unemployment.
Mm-hmm.
The idea that the unemployment stat will start to increase because a
Yeah.
lot of these companies might not be able to, pay their debts, right?
Yeah.
So we'll see what that happens. But if we're saying a correction, theoretically, if we're due for a correction, and I don't disagree, actually, I think that
Mm-hmm.
there is something looming.
Mm-hmm.
What does a correction you think? And once again, we think.
That's a tough question. It really is. I mean, what I think should happen, honestly, is that interest rates should continue to rise to a point where property values start dropping, to the point
Mhm.
where the middle class and the great vast majority of the middle class can afford to buy a home and be comfortable living in a home, where you're not levering yourself to the point where it's unaffordable.
Mhm.
And I mean, from an economy standpoint, I think that's healthy. Um,
Now, will interest rates rising at that rate? Will
mhm.
not that be counterintuitive to people's capacity to borrow?
Yeah, 100% it will. And I think that's good, though. I don't think
Mhm.
it makes sense for us to have 1% interest rates for a long time period where you are incented to lever up as much as possible.
Yeah.
It can just put you in a pretty stressful situation. I mean, even looking today, if for those that are trying to renew today, if you had a 3% or 2.5% interest rate 5 years ago, you're coming into your renewal now. Well, for every $100,000 or whatever, if it's costing you $100 more to renew at that level, then that starts to become expensive. If your debt load is $1 million, 800,000, whatever it happens to be, that's a huge carrying cost, year over month, year over year. And we're going to see the effects of that a little bit more in the next few years when those 1% rates start rolling, or the 1.5% rates start rolling to a 5 or a 4. So
Mhm.
it's been interesting to see the Bank of Canada's thoughts too, where initially the expectation was there would be some interest rate cuts this year. I still think that is likely, but it's kind of been pushed back a little bit later in the year as opposed to being more front loaded. So I think the expectation still will be that it comes down, the overnight rate anyway, and that may have an impact on prime. But I think that's kind of already priced into the government of Canada's and CMB's right now. So
Mhm.
it's I'm what I think should happen and what I think will happen are probably two very different things, and I think it's pretty difficult. It's a tough job for the Bank of Canada to kind of figure out what to do with when their only mechanism really is raising or lowering that overnight rate. You're trying to
Yeah.
balance inflation, you're trying to balance recession, you're trying to balance what people can really afford here, and it's tough. It
Well,
really
the real
is.
estate economy is such a huge part of what Canada provides or offers. So it's like,
Yeah.
I find that the sellers often hold the line because they don't
Hmm.
want to take a bath on their properties, right? So they're
Yep.
going to try to
Yep.
hold values as best as possible. So I guess the only time you're forced to sell is in a situation where you legit can't afford and you have to bankrupt or you have to foreclose.
Yeah, that's true. And obviously that's not a position you want to put people in, but it's the way you really shake the market, I guess. And it's I mean,
Yeah.
I don't really wish that for people, but if there is a way to impact prices materially, that's kind of the way it has to go.
Now, if I would also see that if the average property value decreased substantially enough, I think
Hmm.
you'd have a huge influx of people like ourselves, like
Yeah.
investors, who would want to be coming in and nabbing these properties for, next to nothing. Because
Yeah.
the reality of it is that Canada is so concentrated to these small pockets, and I say
Hmm.
small in with respect to, let's say, the states, where
Yep.
every state has it's seemingly a metropolitan city that is substantial, versus
Yeah.
Canada has what, like five, six,
Hmm.
across the whole
Hmm.
landmass.
Yeah.
So that high density and that concentration and our agenda with immigration is still creating a massive supply deficit.
Yeah.
So I think that it's going to be very interesting to see what happens. But predicting the next moves, I think, is always a challenge in these kind
Hmm.
of tumultuous times where there's volatility. To know, because I get it, the real pros like you guys are grinding the data and trying to come up with what the forecasts are.
Yeah.
It can be a this is why we have you guys on, right?
Yeah, yeah, you're not wrong, right? I think that's going to play a factor too, is just that demand, and there's going to be demand from guys like yourself who are going to see distressed assets, and that's exactly what you want to target because you're getting a deal, and it makes sense for you and for your company to pick that up, turn it over, make it palatable for whether it's resale or rental at that stage. So I do agree, and I think you're right. Immigration plays a big part in this as well. I mean, pie in the sky solution is, you know, in order to kind of change the landscape a bit in Canada is to kind of and I don't know how realistic this is, but when you are kind of accepting immigrants, it's maybe don't go to a Toronto, don't go to a Vancouver, go to a Hamilton, go to a secondary market, build up that. So huge CMAs, you kind of have 9 or 10 spread across the country, and that kind of makes maybe the value of everything, the GDP in that area
Well,
stronger,
I don't know
relatively
if you
speaking.
saw the net migration report that came out for actually Ontario lost, I guess, in total about just under 6,000 people.
Really? No, I didn't see
Yeah,
that.
last
Yeah.
year, and
Okay.
every province actually lost
Hmm.
except for New Brunswick, which had a net gain of 21 people, and Alberta that had a net
Yeah.
gain of 17,000 people.
Really?
Yeah. So,
Okay.
we're also right now looking at Alberta as a viable option to start to invest because
Hmm.
I find that in these the reason larger deals are challenging, I think, in Canada, comparative to, let's say, the US, which we have also bought in the US and we are continuing to scale our portfolio there as well.
Yeah.
However, you have the ability to execute on a business plan.
Hmm.
And
Hmm.
unfortunately, like unit turnovers are a byproduct of selling a property because you have to completely gut units sometimes, right? You don't have the
Yeah.
capacity to have a person living there while you're literally updating the wiring from knob and tube to copper wiring,
Yeah.
or
Yeah.
galvanized plumbing. You got to change that to proper PEX or
Hmm.
sanitary, right? Or PVC, sorry. So the challenges, though, in Ontario is that often that's just not in the cards. You're not going to make it happen. But places like Alberta, where they don't have these kind of restrictions, still
Hmm.
remain a safe haven for
Yeah.
investors who want to go and try their hand. You're seeing it in the property values there. You think you'd score a deal in a suppressed market for a long time, but now they're starting to
Hmm.
kind of reinvent themselves, very similarly to like Hamilton, let's say, right
Yeah.
after the
Yeah.
steel crisis here. So now Hamilton's done very well on reinventing itself, and I'm
Hmm.
thinking Alberta has got some good leadership in place that are doing the same thing.
Yeah, that's you bring up a good point too, because elections and the people you put in place to create these rent controls or what have you, that has a massive impact on your business, and it's kind of our business as well. On a
Mhm.
go forward, what's the best plan? What assets are we going to target? What locations are we going to target? Because if you have rent controls where you can't get tenants out, get new tenants in, the building may not be viable
Yeah.
at its price point, right? So, no, I agree. It's tough. It's tough, and that kind of has an impact too to the overall market and the overall economy as well. It's tough to weigh everything when you can't really forecast that kind of stuff, right?
For sure. For sure. And I think what it's also doing is creating more of a void. Like the big players don't have
Yeah,
to sweat that kind of thing. It's
for
like
sure.
someone like me, I'm like, looking very closely at the decimals, not just the dollars. But it's
Yeah.
like, and you're buffering your numbers to make sure that you're
Hmm.
protecting your investors' money
Yeah.
to, at the end of the day, it's like no deal will work ever. So you almost have to find some sort of creative way to change something so substantially that you can create the value out of just the idea, right?
Yeah.
Which we actually did that one on Helms Avenue. That's one of the
Hmm.
ones, the first one actually, I think that you helped us on was the
Yeah.
apartment
Yeah.
out in
That's right.
Welland, where
Hmm.
we actually changed those two commercial units into residentials and made a huge win out of it. Actually, it was awesome.
Yeah.
So the other thing I want to touch on, so the latest inflation numbers that came in as of December actually went up.
Hmm.
So I know that some people say that this is kind of par for the course. December typically does have more inflation because Christmas, people are spending more, that kind of thing.
Yeah.
But do you think that that is also the case, or do you think that it's actually like we're heading in the right direction from an inflationary standpoint, and that was just the 1 month as they discussed?
Yeah, it's interesting. I kind of read the commentary from our president on this earlier today as well, and his thought was kind of similar that it is a the blip in December where it is commonplace in that
Mhm.
month, that the discretionary spending would be higher, and it kind of makes sense from a inflationary standpoint. Um, It'll be interesting to see what happens the next few months now that December's passed. We're getting into a new year. You're over that end of the year hangover, and let's figure out what to do in the coming months. And I think the decisions on whether to raise interest rates or not will kind of be impacted a little bit by where the inflation numbers shake out. So I, I kind of tend to agree where it's probably just a December thing.
Yeah, it's interesting. Like I was out with my wife last week or whatever, and you still, it's a weeknight, and you still
Hmm.
see like every restaurant's packed.
Yeah.
It's hard to believe that. And I'm prefacing this. I know obviously some people are hurting,
Yeah.
however,
Yeah.
not enough for it to make a splash, seemingly, right? And so this whole idea, like I saw an interesting uh, like video. There's a guy named Ken McElroy. You ever heard of him?
I haven't. No.
Yeah, he's in the U.S. He's a YouTuber guy, but he's
Okay.
part of like the Rich Dad platform,
Oh yeah.
and
Okay.
he
Okay.
he did a video that like a side by side video of like the 1970s, the Volcker
Hmm.
era, and
Hmm.
now, and the similarities and what's happening. And he does preface he doesn't think it's going to be the same thing, but it's interesting to see what happens when you don't stifle inflation.
Yeah.
And if you let that thing go rampant, it is like a world of hell that you unleash on the economy.
Yeah. It's that's why it's so tough, right? And I think early on when the Bank of Canada was raising rates so quickly, their commentary was we need to get inflation under control. We are okay to put the country into a recessionary environment in order to do so. And I think they probably thought the same as well, right? Where the effects of inflation being too high for too long would be worse than sending the country into a recession.
Hmm. Yeah, very, very interesting. So a couple other things. I was hoping to talk to you
Hmm.
or share with our listeners a little bit about breaking down the bond market. And we
Okay.
hear a lot about bonds and treasuries and yields and
Yeah.
things like
Yeah.
that. I thought maybe you could help us kind of, in simplistic terms, identify what those mean, how they get,
Hmm.
what causes them to fluctuate, and how does that affect us from a mortgage sense.
Sure. So,
It's a
I mean,
loaded question, so we can
yeah,
start wherever you want to start on that.
yeah. So there's a lot there, but high level, um, there are a lot of bonds in the bond market. You're going to have, your government of Canada's, you're going to have your corporate bonds, you're going to have, GICs, any investment vehicle really on the fixed income side. Specifically on our end, we use on the conventional side, we're going to use the government of Canada's as our hedging product, and on the CMHC insured side, we're going to use the CMB bond. which is the bond that's it might be a little bit less simplistic, but when we're selling bonds into the market, you create loan pools on the CMHC insured side that you wouldn't on the conventional side. On the conventional side, you're hedging one asset as opposed to selling a pool of assets into the market. But basically, the government of Canada's and the CMB bonds are moving up and down every day, similar to how stocks are going to move. They're going to be impacted by news in the market. They're going to be impacted by where the Bank of Canada's reports come out. They're going to be impacted by consumer data. They're going to be impacted by war. They're going to be impacted by elections. They're going to be impacted by anything. A lot of the time, bonds are changing. We don't know what caused the bonds to change 10 basis points or 15 basis points in one direction or the other. So what the bonds
how
try to
often do they fluctuate, by the way? Is this like the stock, you can follow like a ticker kind of thing?
Yeah, that's exactly it. So internally, we in order for us to see these bonds, we use Bloomberg terminals, and we're actively tracking. Our treasury team actively tracks the movement in these bonds because they're making purchases, they're selling assets into the market, and anytime we're hedging for or locking an interest rate, we're basically selling a bond forward, maybe using a repo vehicle. We're using some type of vehicle to hedge against that interest rate risk. So basically, these are constantly moving up and down every second until the bond market closes, which is similar to the stock market. And then it's just a function of timing for us. Like when we choose to hedge, that's the interest rate you're going to get as on the commercial side, wherever the bond happens to be, plus some sort of spread. The government of Canada's just tend to loosely front run what is kind of happening in the market. So prior to the Bank of Canada making a decision to increase or decrease interest rates, typically government of Canada have already priced that in. They're priced based on expectation on a go forward basis, as opposed to marking it to market when it happens, like prime would be, for example. So as soon as the Bank of Canada overnight rate increases, the prime rate increases instantly to match it. So if you have any floating debt, construction debt, anything like that, that's based off of the prime, any change to the overnight rate, that's going to be reflected there too. So I'm sure if you're doing construction deals, if you're doing anything like that, you see I'm prime +1, prime +2, prime -1, something like that. You're impacted by that overnight rate, similar to how you would be, I think, on the residential side.
For sure, yeah.
So it's any of the variable stuff. So yeah, it's an always moving vehicle up or down that's just trying to match movement in the market, movement in the CPI, movement in demand, movement in supply, movement in the Canadian market as well as overseas market. One good example of major volatility happened when the war for the Russia-Ukraine war was going on, and it was just a massive amount of volatility that kind of happened all at once. And there were days where our treasury team would come to us and say, "Hey guys, we can't lock the rate for you today because bonds are going too crazy. We got to wait to see where these settle down. We don't know." So there were maybe a couple hours during the day where they just said, "We can't do anything right now until it settles." We saw 20, 30, 40 basis point moves. It really was. It was a very strange time, but it's kind of a testament to our team who still during that time allowed us to rate lock deals early, to take on some of that risk in the back end for our better clients. So that's something that we know our clients are very cognizant of now, because we've seen that volatility firsthand over the last year or two, where in a normal environment, if the if the bonds would move more than 5 basis points up or down, there was probably some news article, some reason, something you could tie it to. Whereas now, bonds might move up 10 basis points and nobody knows what happened. Or, you'd have to go talk to Treasury. Okay, what happened? What came out? We didn't see anything. It's not clear to us. And it's been a different it's been interesting, but it's been very educational the last year or so going through
Oh
this.
yeah. Yeah, honestly, I feel like I have like a minor in economics after the
Yeah,
last few years.
exactly.
You
Yeah.
end up like I'm super fascinated by geopolitical politics and how
Hmm.
that affects the globe.
Yeah.
There's
Yeah.
some really, really good YouTube channels that I've been watching that, especially like the significance of things like oil and the oil
Yeah.
trade and
Yeah.
how that affects our markets substantially. Like
Hmm.
it is just absolutely fascinating. So, back to the bonds for one moment, and this isn't really a real estate related question, but
Sure.
there's a lot of arguments saying that a lot of people prefer stocks, of course, because
Hmm.
there's more movement, there's more opportunity to
Yeah.
strike the iron with stocks than is bonds. Who do you find are the major bond holders, and why would someone invest in bonds versus investing in stocks if the returns could be that much better?
Yeah. That's a good question, and I kind of think back to when I was in university, and it was, I was going through a on an investment team at the university, and we were just trying to fire that up. And even our prospectus was, let's hold 60% equity and 40% fixed income. So
Mhm.
it's kind of been similar. It's kind of been ingrained in me to always have some piece of fixed income in my book, whether
Mhm.
that's real estate, whether it's a GIC, whether it's some sort of corporate bond, something like that, just something to diversify yourself a bit.
Mhm.
Um, However, it's been a pretty poor investment the last couple of years when your returns on a fixed income vehicle are 1% or 1.5% versus 10 years ago it might have been 5%, 5.5%. Or even if you look now, if a GIC is trading for 5%, 5.5%, why would I, as an investor, buy a building with a 3.5 cap if I can just go invest that money into a 5.5% GIC,
Mhm.
if I don't see that there would be potential upside in that real estate asset? So
Mhm.
it's that kind of is the question that we have to ask. And if we are trending into a recessionary environment, maybe it makes sense to hold some of that fixed income. Where I think, at a 5.5% return, fixed income is probably going to perform better, well, definitely better in a recessionary environment than the
In a
stock market will.
recessionary environment, bonds go up.
They should, yes. So bonds, the price, but the interest rates may fall as well to help get out of the recessionary environment.
Mhm.
So it's kind of a question of how you want to hold your investments, whether you
Yeah.
think
Well,
you would
one thing
have
that I've learned is like obviously the importance of diversification. Like at one point, Kaylee and I were holding like 97% in real estate, and
yeah,
it's
yeah,
like you gotta think from now we got kids. Now we're not just
yeah,
sprinting right now. You're sitting down like
yeah,
okay, we got to plan a little bit better.
yeah,
But
yeah, that's right.
it's interesting when you're looking across all these different vehicles on where
Hmm.
where the because one thing too that I can't help but like is like a lingering thing, and I'm sure it is in the back of a lot of people's minds, the overall debt that countries have, especially
Yep.
the U.S. and Canada,
Hmm.
um, and this idea of just like constantly printing money. That unless it's stifled, it's got an end date at some point. Something's going to
Yeah.
happen, right? If they're not the leaders in the globe or whatever, and like
Hmm.
this doesn't it doesn't fly, right?
Yeah, that's a good point. Is the end goal to just print so much money that it's not worth anything anyway? If I have $1 trillion in debt or $5 trillion in debt, does it really matter? Am I ever going to be repaying that debt anyway?
Yeah.
Is and who knows? I'm not that's above my pay grade, I guess.
For sure. I was there was an interesting the conservative leader Polyev. He had this video on I forget what the projection was. I think in a
Hmm.
few years or maybe in like the next year. I don't remember, but that the debt has gotten so bad that 25% of Canada's GDP will
Yeah,
actually be going towards paying off the interest on the debt that we owe,
yeah,
which is pretty crazy. And if you think, I was starting to do more research on it and the impacts on what debt, like countries need debt, just like
yeah,
companies need debt. Like if you,
yeah, yeah.
the example that they had was Amazon. If Amazon had no debt, they wouldn't be able to be as they can't maneuver as swiftly.
Hmm.
They have to use
Hmm.
that debt to make the the growth possible, and they would very surely go bankrupt otherwise. But debt is also it's a what's the like a two-headed snake, I guess, right?
Yeah, it's yeah, like that, a double-edged sword. It can really hurt you as much as it can help you. And debt in the right amount at the right time makes complete sense. It's cheaper to raise debt generally than it is to raise equity. So that makes sense from a economic perspective too, that you do want to have debt.
For like CMHC type loans, for example, what
Mhm.
is the longest period that someone can fix their interest rate?
Through CMHC, 10-year terms would probably
Mhm.
be the longest. I mean, we have made some sort of hybrid 15 or 20-year term products available. Typically, the pools themselves are 5-year or 10-year pools. So
Yeah.
um, generally, that's kind of what we see. The majority of our book, anyway.
Yeah. Okay. Awesome.
Yeah.
So the last real thing, because time is flying here, and I'm
Hmm.
not surprised when we and I were
Yeah.
talking. I was like, "Oh my, this is gonna go quick." But
Yeah.
in terms of working with syndications, do you
Hmm.
often work with them, or do you often work more with just larger corporations that are acquiring assets?
Yeah, it's that's a good question. I think we used to work with syndications a little bit more, and I think our appetite has decreased to
Okay.
work with the syndications. And I think part of the reason for that is recourse, is knowing who to go to. If you have a syndication with 30, 40 people, if they're not as sophisticated, they're just kind of investing into an asset where there's no real experience, no real maybe pockets that we can go after. Worst case scenario, it's a little bit of a less strong vehicle for us to invest in than something like a corporation or a family who's been doing it for 20, 30 years, something like that.
Hmm.
And I think from a credit risk perspective, the syndications just are a little bit tougher in the sense of you got AML risk, you've got questions of who's paying what amount, where is the experience and all that coming from. Not to say we
So
don't do it.
when you're referring to syndication in this regard, you're referring to just a mass of people all coming together under one umbrella, or
Gen- Yeah,
but
I guess generally. I mean, there's different types too. Like a syndication could be a one strong investor raising equity and getting some people to take on some percent, where you've got the experience and you've got the equity. That is a better, I would say, vehicle for us than it
like, do
would
you
be a
guys deal with like
pure.
GPLP structures?
For sure. Yeah, yeah.
Yeah, and is that
Close.
something that has like a pretty decent appetite?
I would say so, yeah, for the right sponsor. And I think the GPLP structures kind of make sense because it's either a very low loan to value loan, where at the end of the day you can just say, okay, it's technically non-recourse, or you have enough strength from the one or two major shareholders that are willing to provide a guarantee on it. And
Hmm.
I think those kind of get you over the edge of, yeah, if you want to take a little bit more risk, throw in a guarantee. Or if you're not comfortable with it, we'll just put forward something that makes sense from a loan to value and debt service coverage perspective. I mean, we're not in the business of turning people away. We're in the business of figuring out how to structure a deal appropriately
Hmm.
to meet, credit requirements, plus meet whether it's CMHC or conventional requirements, and something that makes sense for both parties.
Yeah, and you were saying
Mhm.
actually from the CMHC side nowadays that in order to refinance through CMHC, you actually have to hold a loan on the property conventionally for up to a year. I think you had mentioned.
Well, so that's a specific new item that kind of recently came out with CMHC, where if you've done material renovations to a property, or any renovations, that type of thing, you would have to hold conventional lender debt for a minimum of 24 months prior to applying to CMHC.
Hmm.
And that's a, I guess, more specific scenarios with major renovation work as opposed to just a general refinance, which can occur kind of at any time. But there's some other restrictions on that end too for refinances now.
Yeah, for sure. Well, listen, man, this is a fascinating conversation. So if people want to reach you, What's the best way they can get a hold of you to ask you for some advice? Remember, guys, Devin is he deals with larger asset classes. He's not your typical residential mortgage broker, so don't bombard him for that kind of stuff. But he's a wealth of knowledge, you guys, I'm sure you guys can tell, when it comes to this kind of thing. So if you are looking to graduate to the next level and get into larger, bigger buildings like we are,
Hmm.
definitely, Devin should be somebody in your Rolodex. So sorry, back to you.
Yeah, honestly, just send me an email, give me a call. Those are the easiest ways. I'll try to get back to you 24, 48 hours.
Mm-hmm.
And we're always happy to take inquiries, try to, coach, teach, do whatever we can. I hope you can agree that we try to be as transparent as we can with our information, try to help you along the way. Because I mean, it makes sense if you're educated and, we're trying to do what we can to help. It's a smoother process for you and it's a smoother process for us too.
Yeah, you guys have been a dream to work with. Honestly, it's
No, thanks.
not just from a customer service standpoint, but also from like there is a concept or a fact of education that comes into this. Like you don't know what you don't know
Hmm.
sometimes, and
For
you
sure.
need to ally yourself with industry professionals who kind of coach you along. Like, hey, we need this weirdo document, and I get it might sound strange, but this is why we need that thing, right? So
Yeah, yeah.
yeah, but it's very good. Well, listen, Devin, thank you so much for spending some time with us today and our viewers. I really, really do appreciate it. Once again, your wealth of knowledge and someone I turn to for advice often. So, thank you once again for being a part.
Thanks, Alex. I appreciate it. Thanks for having me.
All right, thanks guys for joining me on today's episode of the Real Estate Leadership and Legacy Podcast. Don't forget to like and subscribe, and please check out some of our other videos. We've got an abundance out there. We've got a lot of great insight and information, and we'll see you guys on the next one.